Jackie, thank you for joining us today. So 2017 saw the largest annual volume increase in the global trade of liquefied natural gas. Also, the US and other nations are expected to add significantly to their liquefaction capacity over the next several years. How do you see that growth in LNG affecting the global gas market?
Right, so we have all these investments were made in the United States and Australia, and there was a view there was just so much gas that it might take to like the end of the 2020s before we would need to sanction new projects again because there was such a big glut. But what has surprised everyone is we've seen this real ramp up of demand, 4% growth in consumption last year. Because of all the demands from China and places in Asia. And so now the view is that we may need new sanctions here right away, and we may need new supply coming on potentially in the 2022 to 2024 time period. And so I think we're going to start to see more projects go forward in the United States. I mean, there's already some under construction, but even new ones. And I think in Canada as well, we're going to see LNG. And so I think there's a great opportunity for North America to be part of the global gas business that's growing.
And you see that growth in China and Asia continuing?
I do. If you look at the long-term plans of these countries, natural gas is a very important pillar, and it's not just for power generation, it's for other industrial uses and heating uses. And so I think natural gas is looking quite good, even out to the 2040s as a growth commodity.
Okay. So as we know, oil prices have risen quite a bit over the last year, I think 60%. And that was to various factors, including a diminished supply from the OPEC producers. So what do you think about this trend? Will it continue?
Right, so you have to be cautious forecasting oil prices over the last few years, but there's always going to be ups and downs. But when you think of all the bullish factors right now, I think there's some upward momentum coming. We've got very low inventory levels. We've got this view that like the US could just add all the production we need. Well, we're starting to think that maybe there's some physical constraints to how much oil the US can add. At the same time, we've got dropping supplies from Venezuela and Iran potentially, which means there's going to be not as much OPEC supply coming on. And demand is still going quite strong despite the higher prices. So you put all that together and I think there's going to be some upward momentum here on oil prices.
Okay, and speaking of Iran, so the president announced last month that he plans to withdraw from the Iran nuclear deal. So what do you think will be the long-term impact of such a move?
Right, so there's different perspectives like in terms of what it might mean. Before, they lost about 1 million barrels of exports because of these sanctions. And there's views that it'll be anywhere between 500,000 and 1 million barrels over the next 6 months to a year. But it's still uncertain how fast this will happen. But all things the same, if we lose 500,000 to 1 million barrels of supply, all things the same, price has got to go up. And spare capacity in OPEC, even though they can offset that, is going to get close to historical lows. So I think it's another bullish factor in terms of where prices might be going.
Okay, and looking ahead, when do you think we'll see a peak in global oil demand?
Right, so we've done a lot of work on this, and you can see some of it at our website. But basically, we've done some detailed modeling of a very aggressive scenario for electric car adoption, because that's really the question is, peak demand is probably going to happen because of the electric car. 30% of all the uses for oil are for light-duty vehicles. So we still have lots of other uses for oil, but that 30% wedge, there's concerns that it might start peaking. But even if you take a very aggressive view of the adoption S-curve for electric cars, it's very hard to see a peak in terms of oil demand before 2030. So we have lots of good math to back that up. We're looking at things like the scrappage rate, the fleet size, the effect of ride sharing and autonomous vehicles, but even then, even with aggressive assumptions, it's hard to see a peak much before that.
Okay. So in 2017, your organization, ARC, issued a report titled Crude Oil Investing in a Carbon-Constrained World. So in light of the financial risks associated with climate change, what are some of the key considerations for institutional investors looking to invest in the oil and gas sector?
Well, institutional investors, many of them, believe that we're going to a lower carbon world, despite the fact that the US really doesn't have any policies in place now that in the long term, that's where we're going. And so when you're looking at oil on the upstream side, there's a real difference in the emissions from certain types of crude oil. Some crude oils are 4 times higher emissions than others. And so, our paper was basically to help inform investors, what is the carbon footprint of different assets, and what are those lower carbon assets that might do better in that lower carbon world. And so we've had great take up of it. It's not hard to make an estimate, and it gives you kind of an idea of where you sit when you're looking at new assets. And I think more and more, carbon is going to be a differentiator for how people look at what oil and gas assets they want to invest in.
Okay. Interesting to see how that plays out.
Yeah.
Thank you, Jackie.
Well, thank you for inviting me to the conference.